A new episode. Actually, it's a new lecture. It's a new lesson in personal finance. We're having a little technical difficulty here, but we should be live on Facebook and YouTube. So feel free to leave a comment. Let me know you can hear me, and I'll see your comments, and I'll thank you for that. I'm going to go ahead and open the Zoom room now. Give me just a minute. Let's see. Sorry about this. I'm just having a little bit of difficulty. I restarted my computer, which was probably not a good idea to do just before class starts, which is restarted my MacBook, and my video settings didn't work very well. So now I see Zoom is looking pretty weird. So let me get that fixed. Oh no, that's not going to work. Okay, let me go back and let's go here. Let's go here. If you're watching on YouTube, you're seeing basically a catastrophe happening, which happens every once in a while, I guess. So I'm just going to use, for now, I'm going to use what I can use. All right, I'm going to go let some folks in, admit all. Welcome aboard. Welcome, welcome. Welcome. If you're joining on Zoom, please let me know you can hear me. I'm having some difficulties this morning, some serious difficulties on my software. So we'll get through it, but I'm not sure how. I apologize. I'll do my best to make it up to you. So give me just a second here, and then I will share my screen. As usual, if you will go ahead and post your comments in the chat, just let me know you're here. That would be helpful. And I will try to get through my technical difficulties. Can you hear me? Somebody please let me know you can hear me. Can you hear me, Nan? I can't hear you. You're not muted, so let me just go make sure I have my preferences set correctly. For audio, I got the wrong speaker, so that'll fix me there. For you, I'm assuming you can hear me, Nan. I couldn't hear you because I had the speaker set up for my microphone. So I'm so sorry. I shut down my computer this morning. Just like a few minutes ago, I thought I'd refresh everything, clear out the cache. That was a bad idea because it resorted some things, and I updated my Ecamm Live program. So at any rate, I'm very sorry. I'm going to share my desktop with you, which means you should now be able to see my screen. I hope that's not. So I'm going to jump over here, and I'm assuming you can see my screen. And we're going to talk about the Credit Crush assignment today. So it's time to get started. Let me just try to jump into the Zoom meeting, make sure everybody's been admitted who wants to be. We are live on Facebook, and YouTube. So here we go. And I'm assuming you can see my screen. Wow. I'm so sorry for this. I'm having to basically figure out things as I go here. So hopefully you're seeing my screen. I'm showing you Safari, what's on my screen. And this is a post that I created this morning, which is the assignment for this week, the Credit Crush Part 1 assignment. So that's what we're going to talk about today. We're going to talk about debt strategies, and I'm going to help you get set up for your next assignment in Blackboard. And this is going to be part of your Capstone assignment. So remember the Capstone assignment, that's the big one that's coming up that is in place of your final exam. So before I get started, can somebody please just let me know you can hear me, because I changed my speaker and I haven't absolutely confirmed it, and I hate to go on and on and on without. Awesome. Thank you, Nan. I appreciate it. Right. So here we go. So I wanted to talk about last week's assignment before I jump into this week's assignment. And I just wanted to let you know that, well, it's my favorite assignment to grade, the first memories of money and the interview. And I just can't tell you how much I appreciate you guys sharing your stories. I know it's a very unique assignment. And based on the homework assignments that you did and the response that you gave me in terms of what you learned and how meaningful it was, most of you took full advantage of this assignment to really achieve the goal of the assignment, which was to learn from someone that you respected, to ask them questions that you probably have never asked before, and they probably have never been asked those questions before. So one of the things that I do as a financial planning professional, as a certified financial planner, is I ask a lot of questions. And the first memory of money, that question is one of my favorite questions to ask clients and prospective clients as we prepare to get to work building a financial plan. And as you guys discovered, a lot of you discovered this in a very meaningful way as you interviewed someone in your family that you respected. And I think you'll discover this more and more as you move forward, as this has kind of been this idea that your first memories about money kind of set the table for your the way you think about and the way you behave with money throughout your lifetime. So your early memories about money, and especially when you stop and think about what are your first memories of money. Maybe it's the first paycheck, maybe it's the Easter bunny or the tooth fairy or Christmas or your birthday. But whatever that is, it kind of sets the table. And so I think it's an important idea, an important kind of element in terms of recognizing who you are and how you react and interact with money and financial decisions in your life. So hopefully all of you gain something valuable in terms of that interview that you did with someone in your family. So it's, like I said, one of my favorite assignments to grade. My second favorite assignment is the Credit Crush assignment, because this is where we jump into a very technical, powerful, I think, tool, which is your financial planning software that you're using, the Right Capital Bayrock portal. And so you're going to do some work in your Bayrock or Right Capital financial plan this week. And that's what I'm going to talk about for the next few minutes. I'm going to set the table for this assignment. It's really two different assignments. This week, you're going to set it up. You're going to set yourself up for the Credit Crush assignment. And then next week, we're just going to take it a step further so that you can actually see some debt strategies that will give you really clear insight about how these different strategies can impact your financial plan and your financial future. So before I get into today's lesson, though, I want to mention something that's coming. So you guys are doing great work building a financial plan. And one of the things I want to encourage you to do, to think about in terms of opportunities, career opportunities. So I want to talk to you for just a minute about a career opportunity that you may not have thought about. And it may not be interesting to you, but a few of you, it may be very interesting to consider the possibility of making a living doing financial planning. So now that you're learning how to create a financial plan, which is a very important part of wealth management, and you're learning that you're getting to do that with me. One of the things that I think I do pretty well is take my clients through an educational process. At least I try to, where they get to not only build a financial plan, but understand a little bit about financial planning. And so you're getting to do that as a student early on. And that's maybe more than you bargained for in this course, but I think it's going to be a very helpful foundation for you moving forward. So if you're thinking this is interesting and you're enjoying it and you feel like this is something that really could provide value, then I want to just kind of plant the seed that the industry, the wealth management, financial planning, financial advisory industry, industry is a great place to make a living. And the opportunities have never been better, in my opinion. And so I've been asked to speak on a panel. We're going to have multiple opportunities over the next, year or so, where we will be talking to students about the opportunity in wealth management and financial planning and providing financial advice. Now, I don't know if you know this, but there are tons of companies out there that want to work with the Bauer College of Business. There are companies that are operating in this space, wealth management. And so a lot of these companies, they're just looking for salespeople, honestly. And I don't blame them. I mean, it's hard to find a quality candidate who has the right stuff to sell financial services. And I've been in this industry for a long time, and I know how it works. And so the good news is that there are some companies out there and some opportunities with independent firms where you can take your passion and your skill and even what you've learned and what you will learn in this course, and you can really leverage that and build a career. So if that's even remotely interesting to you, I'm going to keep you informed of when this opportunity is to come to, it's at Melcher Hall. So if you're on campus, it's easy to get there, but you'll get some extra credit. You'll get 50 points extra credit for being there. So, but mainly I want to invite you to think about the possibility of a career in wealth management. And I'll be talking more about that in the weeks to come. I just want to plant the seed today as we jump into the Credit Crush assignment for you to think about and start to just think about and maybe reflect on the possibility of looking at a career in wealth management and financial planning. I'm not trying to sell anyone. I think it's a great place to make a living. I think it's a better opportunity than it's ever been for a young person. And I'll tell you why when we get to our panel discussion at Melcher Hall. So I'll keep you posted on that, but I just wanted to plant that seed. So let's see. First Memories of Money, that was last week. That assignment is kind of in the can. Many of you submitted that like last night. And so I will be grading those assignments later today and tomorrow. Those of you who did it early, by Friday at 3 p.m., you got some extra points. And mostly, I got to tell you, thank you, because if you turned this assignment in early, it gave me a chance to spend some time and really read your interview notes and your first memories of money. And that's very meaningful to me to be able to do that. I feel like I know many of you much more deeply. And for those of you who turned it in kind of last minute or last night or whatever, I will read those and review those, but it may take me a little longer than normal to get you a grade for last week's assignment. So, okay, let's jump into the Credit Crush assignment. And here's how I want to start out. I want to just suggest that hold on, I want to take a look at something. Okay, I'm looking at myself on the screen. I don't know if that's freaking out what you're seeing as I share my screen. I noticed it went into infinity there for a second before. Weird. So hopefully it's looking okay. And you can see what I'm seeing, which is this paragraph that says, now that you've moved out on your own, invested in your dream house, purchased your cool ride, and racked up some credit card debt, let's learn a few debt strategies to help you move toward your goal of becoming a millionaire by age 50. So this paragraph may make zero sense to you at this moment. So let me help you understand what I'm saying here. As we move into the Credit Crush assignment, we're going to be setting up your financial plan. But what we're going to start to do moving forward is we're going to use a little imagination. So starting this week, we're going to add some elements to your financial plan that are totally made up. So we're going to start out by doing a little research, and I'll talk about that research in a minute. But you're basically going to do 3 things in your financial plan this week. This week's assignment is for you to do some research, and based on that research, you're going to make 3 purchases, or you're going to add 3 things to your financial plan. Number 1, like I say here, you've moved out on your own, so you're going to have to do some research to figure out. We're going to go back to that detailed spending plan, that detailed budget, those numbers that create your pre-retirement expenses. Okay, that's a huge part of any financial plan. You've got this group of expenses, your living expenses. That's like the core piece of your financial plan. And when I work with clients and build a financial plan, that takes a lot of time typically to really get clear about what are your expenses? How much do you spend in a year, in a month? Because those expenses are what drive the probabilities of success in your financial plan. If your expenses are low and your income's high, you have a much easier way to meet your higher probability of success. But if your expenses are high and your income's low, obviously that's going to make it much more difficult for you. And so as we go forward in this course, we're going to be building your financial plan. We're going to be adding components. But it's going to be very important that you pay close attention all the way through the course and all the way through your life to your pre-retirement expenses. So I'm going to ask you to go back and take a closer look at those, because as we move forward, I'm going to be looking more closely at those. And this week is an opportunity for you to do a little research and think forward about how much do you think you're going to be spending after you retire, after you have your own household budget. You're living on your own, as I say in this paragraph. You've moved out of the house, you're on your own. You're going to have to do some research. You're going to have to do some real thinking about all of those expenses that currently are being paid by someone else, or being paid through your student loans, or being paid because of scholarships, or because of parental assistance or government assistance or whatever. So you're going to have to think about all of those expenses, from your phone bill to your internet, to your utilities, to the fuel for your vehicle, to the insurance for your vehicle, your housing, your insurance for your housing, your health insurance, all of those things, all of those parts of living expenses. That's what I want you to start to think about. And I want you to think about it in the context of being out on your own after you graduate. Now, I know that's a big reach for some of you to try to wrap your head around how much will it cost, but that's what you're going to do. You're going to build your financial plan starting this week. You're going to build your financial plan based on some of these expectations and assumptions that are really based on your research. And hopefully you'll do a reasonably good job of forecasting the expenses that you're going to have in your life after you move out, after you're on your own. So, in that context, I want you this week to do some additional research and figure out if you get the job that you really want to get when you graduate based on your degree, your focus, I want you to do a little research and figure out how much income you can expect to have when you graduate. That's going to be a big part of your financial plan. You are going to build that into your financial plan. So you'll see how to do that. If you haven't already, you should already know how to go in and add your income to your plan. But you're going to do that, expenses, income, that's the first part really. But then you're going to go and you're going to do some more research and you're going to figure out, where do you want to live? What is the house that you can afford to buy? In what neighborhood? And you're going to have to do a little research to see, okay, if I live in that house in that neighborhood, and you can search Zillow, you can search any tool you want to actually pick the house that's for sale that you want to buy. And then you're going to have to do a little more research to see what kind of interest rate are you going to have to pay in order to get a loan, a mortgage on that house. And you're going to build that into your financial plan. You're going to see where to do that. So you're going to buy a house, and you're going to put that house into your financial plan, which will now become another expense, another weight, if you will, in your financial plan. And it's imaginary, but it's going to be helpful so that you can see how this all works. So you're going to do a little research. You're going to go shopping for a house. You're going to plug that house into your financial plan, and you're going to use as many of those fields in that data card as possible, and you'll see that in the assignment. And then after you buy the house, you're going to figure out, what is the cool ride that you want to own? Like, what are you going to use for transportation? And so maybe in reality, you're not going to have a car because you know that a car is expensive, insurance, taxes, tires, maintenance, all of the things that go along with a car. Maybe in reality, you're not going to have a car, but for the purpose of this assignment, you're going to go find your dream car. So I may have mentioned last week that I upgraded my motorcycle. I've been driving a 2006 Goldwing motorcycle for some time, and I've been thinking, okay, one day I'm going to get a new one. Well, in 2018, Honda came out with a DCT, dual clutch transmission. That's an automatic transmission. So this week, I picked up my new motorcycle. It's new to me. It's a 2018 with 10,000 miles. So I had to pay taxes on that. I had to get a new tire. I needed to get some oil to do an oil change. So all these expenses, my wife is going to go pay taxes today so that I can register that new vehicle. There's a lot of expenses that come with vehicles, even if it's a motorcycle. I had to go on campus yesterday because they won't give you a new tag for parking. You have to pay for the next, even though I traded bikes, I would have thought they'd give me a new tag since the old bike's gone, but no, I had to pay $100, $95 to get a new sticker to park on campus. So expenses. Your vehicle is part of your assignment this week. You're going to pick, a lot of you are going to go for the Tesla or the Beamer or whatever, but pick the car, your dream car. And remember, it's kind of for fun, but it's really to help illustrate the cost of these things in your life. And so treat yourself nicely. Get the cool car, your dream car. When you buy your house, I would encourage you to think about buying a house the way that you would think about buying a house. Okay, so some of you are smart enough to know that you want to buy as much house as you can afford as early on, because your assumption is, and this may be an accurate assumption, that the cost of a house is just going to keep going up. Now, that's a good assumption for you to work off of. If that's your assumption, then you would want to buy as much house as you can afford. So just use a good thought process. I'm going to ask you to tell me why you chose that house. So it's going to have to be something you can afford based on the assumption that you're making X number of dollars because you got the job that you wanted to get after you graduated. Does that make sense? I hope that makes sense. I'm going to jump over to Zoom and see if I have any any chats. I don't see any chats. Let's see chats. If you have any questions, okay. You can hear me. That's great. So if you have any questions, I'm looking at chat. You're probably seeing the chat on the screen now. Let me go back to get the chat out of there. I'm kind of working in the dark here because the normal tool that I use, Ecamm Live, for the video is not working, and so I'm improvising, and I'm really not sure how it's coming out on your end, but I'm assuming you're seeing my screen the same thing I'm seeing. So that, again, you're going to make 3 purchases. Number 1 is your house. Number 2 is your dream car. And number 3 is I want you to get some credit card debt. And I want you to use at least $10,000. So you're going to have to do a little research and find out what kind of interest, what kind of fees would you pay on your credit card. And if you went out and spent $10,000 on a credit card, I want you to do a little research so that you can prove to me that you understand what kind of interest, what kind of payments you're going to have on that credit card. So that's your assignment. That's what this paragraph is about. And we're going to use Billy and Sally. I'm going to tell you a story here about Billy and Sally, because Billy and Sally are they're the subjects of the Credit Crush assignment. When I started teaching this course back in 2012, January of 2012, I shared a little bit about my story. My friend Sam and my other friends at Einstein Bagel, we would get together every week to just share life. And I was a little nervous because I'm going to be teaching personal finance at the University of Houston at the Bauer College of Business. And it was a big deal to me, and it still is. Because I was a certified financial planner, my friends all told me, "You've got this, Jim, you'll be great." But not my friend Sam. My friend Sam said, "No, you need to make sure you teach them this." And his number one thing was teach them the law of spending and saving. If they don't spend less than they earn and save more, they're going to be like every other American, and they're going to fail, and it's going to be miserable. And you need to teach them that. So you can thank Sam, who's since passed, but he was very clear. Sam was a great man, great influence in my life. So anyway, based on what my friend Sam had told me, I was paying close attention to just everything around me related to how people manage money. And one of the things that happened during that season, I took my Lexus to Firestone to get some work done, transmission work, just really changed the fluid. It was a dirty job and I didn't want to do it. I do a lot of my own work on cars because I was a master mechanic. But there's some things I don't want to do because it's just not worth it. And that was one of them. While I was there at Firestone, I met Billy. Billy was there with his Ford F-150 pickup truck. And Sally was the lady who Billy worked with. She was the service manager. So we're both talking to Sally, and she's getting us set up. So that's what this story, these are the 2 characters in the story. And I'll tell you the story, and then I'll tell you the rest of the story. So Billy's in line. He's got this Ford F-150 pickup truck, and he got it from his uncle. He got a really good deal on it. Now, I don't know how you feel about cars, but I'm a car guy. I was a master mechanic for many years, and that's how I paid for college. And so, I'm talking to Billy. He's young. He's like college age. He just graduated from San Jac. He took a 2-year tech training, and he was working at a marathon plant in Texas City. And I happened to have a little business there in Texas City. I had just sold it, but it was a vending machine business. So I owned 19 vending machines in the plant that Billy worked at. So that's how we kind of connected. He worked in that plant. He lived at home. He was making really good money. I had a 2-year technical degree, and he was making really good money. And he bought this vehicle, this F-150 truck, from his uncle, got a really good deal. It was a great looking truck. And I don't know what you know about F-150s, but Ford F-150 pickup truck is the single most popular vehicle ever sold in the world. Okay, it has sold more units. I'm pretty sure I'm right. I'm 100% sure I'm right. That doesn't mean I'm right. I could be wrong, but I'm 100% sure I'm right. And I'm pretty sure I'm right. Ford F-150 has sold more units than any vehicle in automotive history. Okay, so it's a very popular truck. Being a master mechanic, I understood why it's such a popular vehicle. It's just well built. They say built Ford tough. Well, the Ford pickup truck is built like nothing else. It's built well. And so anyway, I was like, dude, that's awesome. I'd love to have a Ford F-150. I don't really need one, so I'm not going to buy one. But anyway, he had this truck. It needed tires. He came to Firestone to buy tires. So I'm just going to ask you to think about how much do you think it would cost to replace 4 tires on a Ford F-150? So just if you probably don't know, I don't know right now, but every time I go to Costco, I look at the tires and I think I need some tires on my Lexus. But what do you think it costs? If you're on Facebook or you're in YouTube, tell me what you think it would cost. 5,000, Julie says. That's a lot. It's not quite that much. So think about this, Julie. You got 4 tires, 4 rubber tires. 5,000 is a lot for the tires. Anyone else? How much do you think it costs? How much would you pay for 4 tires for a Ford F-150? I don't see any comments in the chat and Zoom. No, I'm not seeing any. Maybe 1,500, Karen says. That's a lot, but could be. Tires have gone up like everything has gone up thanks to inflation. 700. Shelby says 700. Jessica 900. 800. Sahil says. So, those are all good guesses. Honestly, I don't know today what it would cost, but back then it was about $200 a tire installed. But Billy had a coupon, so it was a sale price. He was there to buy these tires on sale. And they were a discounted tire, kind of a low-end tire. And so he meets Sally. He meets Sally in the, she's the service manager. And do you know what Sally's job is? She works at Firestone, and she is a sales professional. And I watched as Sally, the sales lady, did her magic on Billy. So Billy came to buy tires, and he wanted to buy inexpensive tires using a coupon, a sale price. And Sally helped Billy see something that Billy had not seen until he met Sally. And that was what do you think that was? What do you think if you were Sally and you're working with Billy, who has this new to him Ford F-150 pickup truck, and he needs tires, and he's there. He lives with his folks. He's making good money. He's banking that money, putting it in the bank, saving, doing really well. He's frugal. He's going out shopping to get a good deal on these tires, and he meets Sally. How do you think Sally changed the conversation for Billy with his truck and this purchase of tires? What do you think maybe Sally started to talk to Billy about? Instead of buying these cheap tires that are on sale, if any of you have ever worked in the sales profession, or maybe any of you have ever actually had a sales professional work on you, just think about it for a minute. Come on, you got to have some insights here. If you're not watching Netflix right now, if you're thinking about this experience with Billy there to buy tires, and he meets Sally, the salesperson, who's a very, very good salesperson. And as you can see, Sally and Billy, that's Sally and Billy later on in life. And you can imagine what happened. Put him on an annual maintenance or replacement plan. Julie, that's not a bad idea. That's a subscription-based deal that produces a lifetime of income for whoever Sally's selling for. Actually, what she did was she said, you know what, Billy? Those cheap tires that are on sale, they'll do just fine. If you want those, we can take care of that. But have you thought about maybe upgrading to these nicer tires, because Billy, that's a good looking truck, but these tires over here, these more expensive tires, they're going to transform that truck, Billy. And man, you're going to look like $1,000,000. I mean, those were almost her words. Not the truck is going to look like $1,000,000, but Billy, you are going to look like $1,000,000. So imagine, I mean, you've been worked by a salesperson before. Do you get how it works? It's like it's not so much about the value of the tires or the quality of the tires. It's about you having something that's going to make you feel special, that's going to make you better than what? Better than the you were when you walked in. Better than the guy next door or the gal next door. Better than the next truck on the street. Whatever. Sally was really good at her job. So that's what happened. What do you think happened next? Someone who's had a little experience with tires and whatnot on a vehicle. What do you think? What other item might Sally have mentioned to Billy to make his Ford F-150 go from the uncle's truck to Billy's fine ride? Come on, what else? I'm looking at those comments and I'm not seeing a whole lot. New upholstery. Julie, I like the way you think. It wasn't upholstery, though. She's sticking with the mechanical stuff, the tires, and a couple other things related to the tires. What else? Somebody, come on, some of you dudes out there that are vehicle rims. Thank you, Julie. You got it. Yeah, rims. Because with those cool tires that Sally's trying to sell Billy, they're going to look pretty boring on the original rims, but we could really put some bling into this deal if we upgrade the rims. So now Billy went from buying these cheap tires to these more expensive tires to these nice tires and rims. And what else? Anyone else got a suggestion? What else might have gone into the deal? What else would Sally, the service manager, the super sales lady, what else might she recommend for Billy in this scenario? As I'm watching Sally work, because remember, I was a master mechanic for years and I understood, I worked kind of like a service manager in my role as a mechanic all those years. I mean, I constantly was talking to customers about different things they should do to improve the value and the, serviceability of their vehicles. And so new upgrade on the motor. Not really. That's probably something she could have sold, but here's what she did sell. She took the cheap tires and converted those to the more expensive tires with the more expensive rims. And then she suggested, you know what? You really should get an alignment, which is absolutely right. If you get new tires on your vehicle, you can look at the old tires and see how they're wearing. There are 3 angles in an alignment. There's toe, that's the tires going in like this. And there's caster. If you think about, like, if you ever pushed a shopping cart, the front wheels, they're like leaning in a certain way. That's caster. That's an angle where the tires change angle. And then there's camber. Camber is when the tires go in and out like this. So those 3 angles on certain vehicles are adjustable. On a Ford F-150, the way you change the camber is you have to bend the I-beam. It's a very expensive piece of service. Toe is adjusted by turning the tow bar, or the tie rod ends have an adjustment. So that's what makes the tires go in. If your tires are out of alignment with toe, it can ruin them really fast. So Sally was right. She sold him a lifetime alignment. She sold him a lifetime balance and rotation and warranty on each of the tires. So after she got done with all of that, Billy's like, okay, yeah, I need to have the alignment. And then once the mechanic looked at the truck, he found some loose parts, some bad parts in the chassis. And remember, if you're changing those angles on the alignment, That only works if all of those parts are in good condition and tight. If one of them's worn out and wobbly, you can adjust it all day long, but the tires are not going to be in alignment because those parts that hold the suspension together are loose, worn, and flopping around. And so once the mechanic checked out Billy's truck, he found about $600 worth of repairs that needed to be made so that they could do the alignment. Now, let me ask you this, Julie. Let's go back to how much do you think Billy is going to be signing up for from Sally when it's all said and done? He came in to buy these cheap tires on sale. Instead, he bought the better tires. He bought the cool rims. He got the lifetime alignment and balance, and he had to have the repairs done on his truck. Now, instead of $800, how much do you think the total bill is going to be for Billy? Julie says $3,500. Anyone else? That's not a bad guess. Honestly, today I wouldn't know exactly how much that would be, but back then I remember about what the number was because I was there as she did the business with Billy, and it was, Karen says $4,000. Sahil says around $3,000 is Jessica. So it's more like $5,000 actually. By the time they get the wheels, the tires, the alignment, the repairs, the tax, the warranty, it's close to $5,000. I should have stuck with my original. Well, you were right, Julie. You were just, my first question was how much would 4 tires cost? So you were right with $5,000. You were, but I had to build up. I had to tell the whole story to get to the $5,000, because if you went in to buy 4 tires, which is what Billy went in to buy, you'd pay a lot less than $5,000. But here's the deal. So Billy, here he is living at home, making good money. He goes in to buy these tires from Firestone, and Sally, the super sales lady, she helps Billy understand that, dude, you would look like $1,000,000. And you could see a few, what do you think kind of goes on between a young man and a young woman, and attractive, young, vibrant, that was all happening right before my eyes. And I noticed Sally was, she was attractive. She was animated. She was very good at what she did. And Billy noticed too. And they ended up obviously dating. And next thing you know, they're living together. But that's the rest of the story. Back to the original transaction. Now we got about a $5,000 bill. And this is where your assignment this week gets kind of interesting. So if Billy is going to buy the $5,000, what do you think, if he's going to spend the $5,000, what do you think Sally and Firestone have to help Billy make that decision right now? Let's think about that for a minute. You've been in that situation before, maybe, where you wanted something and the salesperson wanted you to have it, and they were going to do whatever they could do to make it easy for you to make that decision. That's what Sally did. That's what Firestone did. And so my question now is, what did they have? What did Firestone have that Sally, the salesperson, could use to help Billy say yes to a $5,000 purchase right now? So what is it? What do you think they had? I'm looking at the chat box and I'm not seeing any answers. If you're watching on YouTube or Facebook, think about it for a second and then give me your answer. What do you think? If you're in that situation with Sally, the super sales lady, and you have this big ticket purchase right before you and you're not sure you can afford it and you don't have the money, you came in with money to buy 4 tires, but you certainly don't have $5,000. What is it? A loan, credit. Yes, thank you, Julie. You're doing great. The rest of your peers. Karen says monthly payments. Yes, Karen, monthly payments, but that means credit, because if you're paying monthly, that means you have a loan. So that's right. Get credit. So now think about, yes, credit is one of the things, but what is part of that credit offer that makes it appealing to Billy? What does Sally have to offer? What is the credit? What is the credit promise? So I'm going to just give you some hints. Firestone and Sally said, look, we're going to give you a low interest loan with low payments. And not only that, we're going to give you 6 months same as cash. Have you heard that before? 6 months same as cash. What do you think that means? 6 months same as cash. 6 months same as cash. Low monthly payment, a relatively low interest rate, but mainly it's low monthly payment with 6 months same as cash. What do you think? No interest rate for 6 months, Elisa. That's right. So for 6 months, Billy could buy everything in that package, in that deal, and he could get it. And if he pays it off in 6 months, he pays no interest. That's the deal. That's 6 months, same as cash. So Sally sells Billy that on the idea that, look, you're living at home, you're making good money, we checked your credit, you qualify. You can save this much out of your paycheck every month, and by the time 6 months comes up, that's less than $900 a month. You just put that aside. At the end of the 6 months, you'll have all $5,000. You pay us $5,000. You pay no interest. Billy's like, that's not a bad plan. I can do that. Signs up, gets the credit, goes forward. What do you think happens next with Billy and Sally? They start going out. Billy and Sally fall in love. They get an apartment. Sally wants to buy stuff, and Billy wants to buy Sally stuff. And they build their little nest, and they build their little home, and before you know it, Sally's going to have a baby. One thing after another thing. But the point is, over 6 months, here's the thing that happens. So for 6 months, and sometimes I do the math, but you're going to do the math yourself in your financial plan where you're going to get to see how this works. So what happens, and this is where, if you pay attention, this is where you'll get angry at credit card companies, because you'll recognize that it is a racket, that credit is not a privilege, it's a product, and it's designed to get your money in their pocket. So the credit scam, the racket, the way that it works, that credit card or that credit, it doesn't have, it ends up being a credit card, a Firestone credit card, and it's pretty low interest. But the promise was if you pay it off in 6 months, you pay no interest. But Billy got distracted with life, and he didn't save, and he didn't have the money to pay it off. So at the end of 6 months, what happens? At the end of 6 months, that $5,000 has an interest rate. What do you think the interest rate would be on a $5,000 credit card loan from Firestone? Think about that for a second, because you're going to need to come up with that number on your credit card. So what do you think Billy's credit interest is going to be on that credit card? Come up with a number. Tell me what you think it is. I mean, he didn't pay it off in 6 months. So now we got to figure out what is in the fine print. There was a credit interest, an APR, annual percentage rate. Tika says 28%, at least 15%, Elisa says. So anyone else? Those are good guesses, by the way. And Billy has pretty good credit when he signs up with Firestone. At that point, he has pretty good credit. So 28%, 15, that's it. About 20%, Elisa says. 28%, Tika says. And at least 15%, Elisa comes back. 25%, Nan says 25%. So those are all good guesses. I don't know exactly, but I would guess at least 18%. So do the math in your head. If you did the math and you said $5,000 times, let's say 25%, just to keep the math super easy. Let's say 20%, because 20% of $5,000 is how much? How much is 20% of $5,000? If you did 20%, that's simple math. I can do that in my head real quick. 20% of $5,000, how much is that? It's $1,000. It's super easy, right? So remember, Billy's going to pay $1,000 a year, every year, for interest on that loan until he pays it off. So after 6 months, if he didn't pay it off, how much would he have to pay for that $5,000 loan? Super simple math, 5 grand. 20% interest means he's paying $1,000 a year, but we're talking about 6 months, not the whole year. So how much does he have to pay each of those 6 months for the interest of 20% on a $5,000 loan? Think about that. It's not rocket science, pretty simple math. 20% of 5 grand is $1,000. That's an annual amount that Billy's going to pay for interest on his credit card. But we're talking about 6 months. The deal was if he paid it off in 6 months, there was no interest, but he didn't pay it off in 6 months. So how much do you think Billy would owe for interest after 6 months on a $5,000 loan with a 20% annual percentage rate? $500. That's simple, right? That's right. And that's right. It's not 1,000 because 1,000 is a whole year, but we're talking 6 months, so you cut it in half. Now, if we did the math, $83 a month, $83.33 a month, Elisa, I don't know for sure that that's right, but I'm not that good with math. If I had to multiply $83.33 by 6, I'm assuming that's going to be around $500, maybe exactly $500. So that's good. So that's what I want you to think about. Let's say that it was January when Billy signed this loan, and the idea that Sally talked him into was to pay it off within 6 months so that he had no interest, but he didn't do that. So 6 months comes around, instead of 5 grand, how much does he owe now? In June, how much is his balance? If he started out with 5 grand, he had a 20% interest. That's $1,000 a year, but instead of 1,000, it's only 500 for 6 months. So now the balance goes from 5,000 to what? Yeah, 5,500. Thank you, Elisa. That's right. That's pretty simple. Now here's the thing. This is where it gets a little tricky. So if you're talking about the first payment now, the first payment would be a $5,500 balance with 20% interest. How much is 20%? Somebody pull out a calculator, because I don't have one. I could get one. I could use mine, but I'm going to ask you to use yours so I know you're paying attention. So on a $5,500 balance now, it's not 5 grand. 6 months goes by, they add the $500 interest. The new balance is $5,500. So what is 20% of $5,500? I know the number actually because I can do the 20% thing pretty easy. Yeah, $1,100. Thanks, Tika. So now we're talking about $1,100 a year. So now it's time to make the first monthly payment. So before, who said, Elisa, I think said $83 a month, which would have been correct on a $5,000 loan at 20%. Stan, you want to leave and come back on your phone? I'll try. I'll try to pay attention to that. You're welcome to try. If not, you'll have to pick it up on Zoom, pick it up on YouTube. But I'll try. So back to the question. Instead of 5 grand, this payment that we're calculating isn't for $5,000 balance. It's for how much? $5,500. So now you do the math. You said $1,100 is the annual interest. So how do you come up with the monthly interest for that? We're trying to figure out the payment for a $5,500 loan with a 20% interest APR. How much would that be? Somebody just do some math. $91.67 a month. Okay, cool. So that's divided by 12. So you get how we do that. Now this is really basic. If we're doing compounding interest, it's going to be different. It would be a different amount, a little more, a little more. But we're just doing basic, simple math here to illustrate the racket of a credit card. Now, so yeah, $91 is the payment. So imagine if we took a spreadsheet And we said 5,500 is the balance. Here's the interest. And we added the interest of 9167. Now the balance goes from 5,500 to 5,591.67 because that's the interest on that's the 1 month interest on that balance. And now we have a new total. And now we're ready to make the first monthly payment because we have the new total. We started with $5,000, 20%, 6 months, 5,500. Now we have to calculate the interest on that entire new amount, and it's 9167. And now, boom, we're going to make a payment. The minimum payment, what do you think? Remember when Sally sold this deal to Billy, and this is how credit cards work. One of the benefits is a low monthly payment. Sounds good, right? If you don't make the payments, if you don't pay it off in 6 months, you're still going to have a low monthly payment. So how much do you think the credit card company is going to require as a minimum payment for Billy on this now $5,591.67 balance? He's going to have to make a payment. How much is the minimum payment? What's the minimum payment on a $5,600 loan? Think about it. I can wait. Give me a guess. Somebody give me a guess. At least 80 to 100. Tika, that would make sense, right? Because if you paid 80 to 100, you would at least be kind of paying down the principal, especially if it's 100, because magically the 100 would be over the 9167. And Elisa says you'd say 120. The minimum, that low payment that they promise you that makes this an attractive deal for you, it's a lot less than 100. It's more like $40. Think about that for a second. 35, yeah, that's probably a good number. 30, in fact, I can go look at my own credit card. I put about 10 grand a month on my credit card because I like the whatever you get free bucks, and I pay it off every month. But I look to see what the minimum is, and it's mind-boggling how low the minimum payment is because that's how it works. That's how they get your money in their pocket. And that's what I want you to learn in this Credit Crush assignment. I want you to be as angry about it as I was when I discovered how this racket works. So you're starting to see how the math works if you're paying attention. So your credit card minimum, Elisa, is $35, but you're not telling me what your balance is. And since we're showing the chat, you don't need to do that because it's but you see, like, I think my minimum on my Wells Fargo card is about $35, and my balance can be $10, $11, $12,000, and they're only going to charge $35. The point that I'm trying to make, don't miss this. If you do the math and you create a spreadsheet, and you can Google this and see a lot of people have done it, you see the balance, and the balance means you take the interest for the whole year, the 20%, and you multiply the balance by the interest, and you come up with a number like $1,100, and then you divide that by 12, and that's your monthly interest, and then you make a payment. And that payment, that minimum payment of $35, leaves you with a balance that's bigger than it was the month before. So that the next month, they calculate the interest, a larger balance, so that the amount that gets added to your balance is bigger than it was the month before. And that's what happens is the monthly interest gets a little bit bigger each month. The balance gets bigger each month, and you're paying more and more interest. And that's how it works. And that's why I want you to do your own. I want you to buy a house. I want you to buy a car. I want you to put 10 grand on your credit card so that you can experiment in your financial plan with different debt payment strategies so that you can see how that moves the needle for you in your plan. So usually when I teach this when I do this lecture. I make you go through a month after month and I show you how that works. But now we get to do that in your own financial plan. And if you're paying attention, if you do this assignment with a little bit of attentiveness, you're going to see what I saw when I was buried in debt and when I had to face the music of getting out of debt. My wife helped me understand what Billy missed, and I don't know that Sally really got it either. Like, she wasn't thinking about how devastating this whole credit scam would be to their lives, but it is. And it still is for people who are in debt and they're not paying attention to how much the interest is, how much the fees are. Because what happened later is Billy got distracted and he forgot to make a payment, so he got an extra fee, and then his interest rate went up. That's how it works. So that introductory interest rate, if you miss a payment, they raise the interest rate. They don't necessarily raise the minimum, but they might raise the minimum. But the point is, you know that Billy and Sally, before they got married, after they got married, they individually had not just one credit card account, not just one credit account at Firestone, but they had one at Macy's, and they had one at Shell, and they had one, a Visa card, and they had a multiple, just like you will likely have in your life, multiple creditors. And each of those creditors has an interest rate and a minimum payment, and each of those are doing their same form of the exact same racket. And so you have to pay attention to the setup. And that's what you're going to do this week and next week in the Credit Crush assignment. So it is 11:04. I have gone over a couple of minutes. I hope this story of Billy and Sally sets the table for you to go and start to do a little experimenting in your own plan so that you can see how these different strategies work. That's what we're going to focus on this week and next week. So you have a couple of weeks. You're going to have 2 assignments, 100 points total. Remember, if you submit your assignment by 3 o'clock on Friday, you get 20% bump. I know some of you can't do that for whatever reason, but I want to encourage you to do that because it's going to help you get your 950 points early so that by the time you do your capstone assignment, you're going to have your A in the bag early in the semester so that you can focus on the other courses that require a more intensive approach to preparing for a final exam. I want to make this as easy as possible for you because this course, Personal Finance, it's not about what you learned this semester. It's about what you learn this semester that you keep on learning for the rest of your life and you keep practicing. So I hope that this assignment, the Credit Crush assignment that we're going to work on for the next couple of weeks, is really a central part of this course. It's a central part of managing money, learning how to manage credit and debt. And that's what you're going to learn over the next couple of weeks. So hopefully this story helps set the table. You'll go into Money Study Group with lots of content and a quiz, and you'll see the assignment posted in Blackboard. I look forward to hearing from you if you have any questions. Hopefully you get your questions answered in GroupMe, but if you have any questions you're not getting answered in GroupMe, please reach out and we'll get you taken care of. So I hope you have a great week. Thanks for being here. Sorry for the technical difficulties. I promise I'll get it fixed for next week. Take care. You bet. Have a good day. Okay, thank you. I see the thank yous. I appreciate that. I don't see any questions, so I'm going to jump over to the live stream and I'm going to finish the live stream. So if you're watching on YouTube or Facebook, I am going to end the broadcast now and I'll keep the Zoom meeting going for a couple of minutes to make sure we answer any